real estate investor and podcast host. There's actually a lot more. I'm reading from his bio right now. He's an American real estate investor, entrepreneur who produces and stars in his own popular YouTube channel. By the way, the YouTube channel has been growing like crazy. If you guys check out Social Blade, it's just been going up and to the right. And I first heard of George through I think it was Robert Kiyosaki. He just kept mentioning your name over and over. And then I saw an interview with you. I was like, I gotta check out his stuff. But prior to 2012, just to give a little intro, George started and operated multiple businesses in the convention and advertising space. So grew his last business to about 24 million bucks in annual revenues, over 100 employees. And he decided to retire, semi-retire at the ripe old age of 38, shift into real estate, and has flipped over 40 properties in and out of the US, relocated to Medellin, Colombia, and then now has relocated somewhere else. Where are you now, George?
I'm in St. Bart's in the Caribbean, just trying to seek out some freedom in these crazy times that we're living in right now.
Yeah, I mean, it's, I have, so I study economics in college, but I never listened. I used to go to this thing called the econ tutor where I went, and it would basically you get an automatic B. The guy just shares all the answers. Like, you have to be, not so smart to get lower than a B. I got a B at least. But, I looked at your stuff and I'm just like, you look at everything that's going on, around us right now. And it's like, you got to check out George's YouTube channel. It's free. And I guess, there's just so many more things I want to say about you. But first and foremost, welcome to the show, George. How are you doing?
I'm extremely well. Thank you for having me. I'm a big fan. I remember listening to your podcast with Neil Patel back in, it was maybe 2000. It was when I was in Medellin when I first went there. So maybe 2015. I would go to the gym. I don't know if you've been to Medellin, but there's this.
I have. Yeah.
Oh, have you? Okay. So I was at the Charlie. I go to that gym at the top of the Charlie Hotel right there by Parque Aris.
Yep.
And every time I'd go to the gym, the first thing I'd do is turn on your guys' podcast, that daily podcast that you have was like 5 to 10 minutes.
Yep.
And I used to kind of geek out on that as well. So I appreciate all the content that you guys would put out.
It's funny how everything connects, because I think I just did a tweet and then you responded to it and then we just started DMing. I'm like, let's get on the Leveling Up podcast. Let's talk about all the stuff that's going on, because I just don't think people are prepared. People, I think there are, I talk with one of my friends who's a VC. We talk every 2 weeks and we just think, stuff is going to hit the fan like really soon. And I just think people, by the time you start preparing when everyone's panicking, it's already too late. So I guess, what are your general thoughts on what is going on right now and how people are, because it seems like you've prepared a lot, but it just seems like other people are just, they don't really know what to do. So.
Yeah, well, I was fortunate. I retired in 2012 as an entrepreneur. And when I did, I knew nothing about economics or investing. I didn't know what a yield curve was. I didn't know what the Fed was, absolutely zero. And I kind of took all the energy that I'd focused on building businesses over the past 10, 15 years and kind of readjusted that into the study of investing. And that's when I got into real estate. But macro is really my passion project. And so I would listen to guys like Milton Friedman, the Free to Choose series, Thomas Sowell, Jim Rogers, Peter Schiff, Stan Druckenmiller, all the guys that are very well known, not only on the Austrian side of economics, but as investors. And that kind of took me down this path and this rabbit hole. And just listening to podcasts, listening to audio books and YouTube videos. And we fast forward to 2019. That's when I started the YouTube channel about a year ago now. And I just love talking about macro. So that's kind of what brought me up to, where we are today. As far as the macro environment we live in, you're right. There's a lot of things that people are, it's almost like they're whistling by the graveyard, to use that term. And I hate to be kind of doomsday, but when you look at the reality of certain metrics, such as the United States debt, such as what the Fed is doing with quantitative easing infinity, such as the interventions in the repo market. And we can go into what that is if you'd like to, but basically for your viewers who aren't privy to all this economic esoteric lingo, just for us econ geeks, that is a dollar funding market. So it's really kind of the plumbing of the financial system. Is called the repo market, or one of the components of it, the largest component. So that really started to have problems back in September, in the middle of September. And then when you layer that over the issues we've had with COVID, and the Fed was committing, they weren't doing, but they're committing to $1 trillion a day in the repo market. I mean, just numbers that are astronomical. It's tough to get your mind around. So when you see them intervening so much into a very complex system, it never ends well. And I look at economics in our economy a lot like nature. And we instinctively know that when man tries to come in and fiddle around with nature, I always use the example of, Florida's having an insect problem. So they bring in all these frogs that eat the insects. And the next thing you know, they've got a frog problem that's 10 times bigger than the original insect problem. We as human beings, we just can't get our mind around all of the variables that go into nature, the weather, things like this. But our economy is the exact same thing. It's a complex system that's really built on quite literally billions of transactions per day. And we cannot micromanage it. And like nature, usually what happens when we try to kind of twist this dial and turn that dial, the net result is a lot worse than where we started. Now, sometimes we're able to kick the can down the road, and you've got a period, kind of like a grace period. And I think we've been in that period of time since 2008, and during the GFC until now. And you look back at the headline numbers during that time, and unless you really peel back the layers of the onion, it looks pretty good. We had unemployment rate down 3-4%, almost at all-time lows. The stock market was at all-time highs. I mean, just look at Trump's Twitter feed. He'll tell you that on an hourly basis. According to him, we've got the greatest economy of all time of human history. It's almost like comical watching him really over-promote it. But if you start to really look at the fundamentals and you see that the economy that we had is, and still have, and even more so today, is built on asset prices, debt, and confidence, you're like, wait a minute, this has nothing to do with fundamentals. And that's when you start to realize that in the future, and it could be tomorrow, it could be 10 years, but at some point in time, we're going to have to pay the fiddler.
Yep. And I guess I was just talking to another entrepreneur yesterday, and he was just saying, because I just graduated college when the GFC hit, and so it didn't really I didn't really understand what it, what were the implications. I didn't know what it felt like. It didn't really impact me that much. I did have a dead end job that was the best job I can get, but so those people that are saying right now, look, 2008, people were panicking. It wasn't that bad, and people are panicking right now. It doesn't seem like it's going to be that bad. That's exactly what the guy said yesterday. And I was just like, in my mind, but I'm like, this feels way worse than anything else. But I'm just working off of gut feeling. How would you respond to the people that are saying, hey, it seems like people are panicking in the past, look, things turned out okay. And, they don't think much is going to happen here. So.
Boy, that's a 2-hour podcast right there just to answer that question. But the first thing that I'd say is you have to look back and see, from an economic output standpoint, how much did we drop in 2008? We all lived, or most of us lived through that. So we kind of understand, even if you were young at the time, that, it hit the fan pretty hard. And we're on the brink of having some serious problems long term. So if you look at how much economic output decreased in 2008, it went down by about 6%. So call it from 100% down to 94%. And to give that some context, back in the Great Depression of the 1930s, economic output went down by about 25%. And we know that created a decade that most people say we only got out of by World War II. I would disagree with that, but it produced a lot of pain for a long time, bottom line. So you look at where we are today with COVID, and you say, okay, well, what would the economic ramifications be if the Fed wouldn't have come in, or if the government wouldn't have created $3 trillion in, the Fed actually monetized it, but if the government would have spent, let's say, $3 trillion into the economy to quote unquote stimulate, and the demand side would have gone down. I mean, even with that $3 trillion of stimulus, and they'll probably do more, we can safely assume, just by looking around at all your friends that have lost jobs and all the businesses that are closed up and most likely won't come back, some will, but not all of them, we could say, okay, we're maybe at 50% right now. I think, in fact, for the last quarter, GDP went down by about that number. But so say that annually we go down by 25% of economic output. Okay, we're in a Great Depression right there. So what's keeping us from, being in an kind of an economic whirlwind that would be even worse than that? It's just the Fed monetizing the deficits of the government. So, and I know that kind of gets a little wonky as far as the terms, but what that means is the government issues treasuries at auction, and that's where they're getting the money they need to spend. Now, technically, it doesn't really work that way, but that's the easiest way to think of it. I know if we got some people that are big into MMT, they're saying, oh, that's not the way it works, George. And trust me, I get it, but I'm just explaining it this way because it's the easiest for the layperson to understand. So they issue the treasuries. And normally what would happen is people like you or I, with savings, or foreigners who have produced goods that we consume here in the United States and have got those little green pieces of paper through the trade deficit, they're going to buy those treasuries or those assets. And then so the government spends the money. So it's the same money supply that's circulating. Well, now what happens is if the government runs these massive deficits, there's just not enough buyers, or the interest rates would go way up. So the Fed steps in and buys the treasuries from the government. Now they do this in like kind of a shell game with the primary dealers, because technically the Federal Reserve Act prevents them from buying this stuff directly, but it's just kind of a wink and nod thing. So the primary dealer buys it and they just flip it right to the Fed really quick. So what ends up happening are these treasuries go onto the Fed's balance sheet. Well, how do they pay for that? The Fed has to literally print new money, or they have to create new electronic money out of nowhere. So they buy that from the primary dealer, and they just add an additional 1 billion in digits, just with a stroke of a computer. And those that $1 billion goes into the bank account. We call it the reserve account that the bank has with the Federal Reserve. That it just adds that $1 billion to their account. So that they're just creating money out of nowhere. Usually that doesn't get into the real economy directly, because that's just, I don't want to get too technical here, but it just gives the bank the ability to create more loans. And if they were to create more loans, then it would affect the actual money that was circulating. But when the government does this and the Fed monetizes their debt, which means, again, basically they print up money, bank reserves to buy these treasuries, the government takes the money and spends it into the real economy. So this directly affects the amount that's in circulation, chasing the same amount of goods and services. The problem we have right now is the amount of goods and services that we have in the economy is shrinking dramatically for obvious reasons. People aren't going to work. And if they're not going to work, they're not creating the stuff. And we're still able to import a lot, but you've got this contraction. Now, generally, you would have the demand side go down as well. If everyone's staying at home, they're not spending money, they're not working, so they have a lot less money. But what's happened to the stimulus is the government has given them kind of this bridge loan, if you will, but it's not really a loan. It's just, you don't have to pay it back. So what we found is that the average incomes in a lot of categories over the past, call it 2 or 3 months, have actually increased in the United States, although unemployment, the headline number is, I don't know, maybe it's around 10% right now. But if you really dive into unemployment, it's closer to 20%. So we've got unemployment at 20% while incomes have actually gone up. But this is a result of that debt monetization or additional money printing. Then it just goes back to, kind of the basic economics, where if you've got a greater and greater supply of currency units that are chasing the same amount of goods and services, if not less goods and services, then you most likely get consumer price inflation. And not all, and you could see asset deflation. You could have some prices go down, but the majority of the prices of the stuff you and I buy daily, those prices go up. So there's never a free lunch. At some point, you've got to rob Peter to pay Paul. And if we're printing up these currency units out of nowhere that we didn't produce any stuff to actually get, then the people who are going to be paying the price are going to be the savers and the people who most likely go into the market, because this creates a higher propensity for this boom bust cycle that just sucks in the average investor at the top. It always works that way in any bubble. We see the people taking the stimulus going into their Robinhood accounts and buying bankrupt companies like Hertz. You don't see that at the bottom in the start of a bull market. You see that at the top of a bull market. And unfortunately, you know, we as human beings, we get emotional. I believe the market hurts the most amount of people possible. It just sits there and waits till everyone's on one side of the boat, and then bam, it flips it over. And those are the people that will have to pay the price. Fortunately, there's people like you and others out there that are kind of saying, hey guys, look at this, so we can prepare more people. They can understand how this works, so they don't fall into that trap and get hurt long-term financially.
Thank you for that. I think a lot of people that watch this, so, you know, I'll talk to a lot of my founder friends. Fortunately, they all have digital businesses, and, you know, they're crushing it right now, right? Nobody's saying anything. But here's the thing. It's like at some point, everything comes crashing down. And even if you're crushing it right now, I still think you're going to be at risk as well. Do you agree or disagree with that sentiment?
That really depends. I think that if you're doing an online business, you've got a much better go of it than someone who's got a brick and mortar company right now.
Right.
And I can compare and contrast the two, because prior to me retiring, that's all I did is just offline businesses. And I don't know if you want to call what I'm doing right now an online business.
I think it is. Yeah.
You do monetize it a bit, so it's worth your time. There's much more of a moat around that when you consider what's going on. But you know, it goes back to that question of the Fed, because if we were just to allow the market to work and have price discovery, asset prices would come down. We would have a deflationary event. Asset prices would come down, incomes would come down, spending would come down, and one man's spending is another man's income. And therefore, that could affect a lot of online businesses. But if the Fed keeps, you know, cranking out this money, and they try to go the inflation route instead of the deflation route, then, you know, the good thing about being any business owner, especially online, is you're not a price taker, you're a price maker. And that just gives you a huge, huge advantage.
What does that mean, a price maker?
Well, you set the price for your goods and services. And so if you've got, you know, if you've got a consulting business, or if you like, I've got this little digital product, I can always raise my prices to go along with the cost of living. But people who are employees, they're price takers. They're paying these prices. And what we've seen throughout history is our wages typically lag inflation.
Got it. I'm going to jump around a little bit because I do want to talk about your current business right now. So what is George's current business? Because you're building this audience, you're spending a lot of time. And by the way, everyone, just go to YouTube, subscribe, check out his stuff, because the time that you put into it, I can tell it's got to be hours, or if not weeks, of preparation for the videos that you make. So what is going on there? What's your vision with, I guess, what you're doing online?
Well, I've always had that maybe stereotypical entrepreneurial mindset that I just shoot first and ask questions later. And I fortunately, by listening to your podcast and others in the digital marketing space, I knew that if I was able to build an audience and serve an audience and to provide value, at some point down the road, I'd be able to monetize it, at least enough to cover my expenses and cover payroll for the editors and everything. So that was the original mindset. I was doing a TV show in Medellin, a house flipping show. And so the deal was I produced it, and then the local network put it on air, and we kind of split the ad revenue. So I had all of these editors and camera people after the first season that were just absolute rock stars. So I wanted to put them to work. That's when I created the YouTube channel. But back then, you know, we were only getting, you know, 20 or 30 views per video, maybe 200 views a day on the channel. We had 100, 200 subscribers for the first 3 or 4 months. But my payroll was anywhere between like maybe what was it back then? Maybe $5, $6 grand a month. But I was totally okay just forking that out, because I knew that if I'm able to hit the back end metrics like click-through rates and the retention rate, that sooner or later the algorithm would pick it up and we'd be able to build that audience. And again, at least I'd be able to cover payroll and keep these people employed who I really enjoyed spending time with and are extremely talented. That's pretty much as much thought as I put into it initially. Then what happened about 4 months into it, and I remember it like it was yesterday, we were getting about 200 or 300 views per day on the entire channel. And in about 3 days, we went from getting, call it 200 views a day to 40,000, literally. Wow. In 3 days. I mean, it happened over a weekend. It was just, in fact, it was so insane. I actually thought that like some sort of, fake click thing in India accidentally picked up my channel. Actually, I thought this has to be fake. This can't be real. But it was just the algorithm picked it up. So then once we started to gain traction as an entrepreneur, of course, you're like, okay, what's going on around me? And how can I make this work to hire more people, create more jobs, and to provide a better service? So then I started doing consulting stuff, and that wasn't a good use of my time. And that only lasted about a week or two. And I started doing some affiliate deals with people who, with their research products that I read myself and I really enjoyed reading, that were that saw the world and investing kind of the same way I do, through this Austrian kind of hard money lens. And same thing, very skeptical of central banks, quantitative easing, money printing. And there's ways to invest using that type of strategy. So I would partner up with them. And about a month ago now, maybe a little over, I just created my own digital product where when I was an entrepreneur, I never created the product ever. What I would do is I would hire people to create a fantastic product and that they specialized in. That was my weakness. And so I would hire all these people around me, delegate, and then I would strictly focus on the top and bottom line, because that's what I was good at. That's what motivated me. So I tried to do the same type of thing with our online product, where I partnered with Lynn Alden, Chris McIntosh, a couple pros that do research. So we put that behind our paywall. We have an online forum. And then a couple days a week, sometimes once a week, we do live Q&As with Lynn and Chris to discuss their most recent research and what they see in the markets and all these things. So that was the next step, to create a membership program, I guess is what you'd call it. And from there, who knows? I get tons of people reaching out that want to sponsor the YouTube channel. One suggestion, and I'm sure you guys preach this, and your viewers probably know this, but is really leveraging the content you're already creating. So as an example, with YouTube, I'm already doing these videos. I'm already doing these interviews with these pros. So I have a person that works for me, an editor, just rip the audio and turn it into a podcast. And it's no extra work on my end at all. And all of a sudden, it's just this extra content that's going out. And that podcast is now getting, I don't know, maybe 25,000 views or downloads a week, or something like that. Yeah, it's substantial. Yeah. And then I'm having them take the interviews that I do and turn that into blog posts for the website, so we can hopefully leverage some Google search. So I don't know what the next step is, whether it's sponsorship. I want to be very careful with that. We'll see. But to your point, if you, or any of the viewers out there, if they're wondering, if you're able to grow a decent audience and if you give them a lot of value, it's just kind of a foregone conclusion. There's going to be many, many ways to monetize. That's not going to be your problem. Yeah. Well, I love that. It'll come back to you in spades. You just keep giving, and then you have a nice problem to have. How do I monetize? And I'm happy to talk to you offline about a couple of ideas that you can try out. I'd love your advice. Yeah. No, by the way, guys, I keep saying this, but I think this is, if I were to recommend one channel for the year, it's George's channel. And when I first was checking out, I think you're at like 90 or 100,000 subscribers. Now you're at 160. So it's picking up quickly. You got to keep in mind, Eric, a year ago, I was at 200. Dude, subscribers. So your growth rate has crushed my, like on YouTube, we're like, slowly growing. My YouTube's like 45,000 or so. And that took years and years to get there. So like people, I think, especially with COVID, your growth rate has to have increased, right? I don't know. When it really increased substantially was when the market got into trouble and we were having all that volatility. The views just really exploded. I almost got up to 2 million views per month. Usually I kind of hover around 1.2 or 1.5 million views a month. and it really went through the roof. But the subscribers have been very consistent. Usually I get about a 1% subscriber rate. So if I get, call it 100,000 views, I'll get 1,000 subscribers. And it just pretty much remains consistent. It's just a matter of how many views I get. I was doing all whiteboard videos at the beginning, 5 days a week, and that was taking up an astronomical amount of time. And I tried to do that, to do like a 90-day challenge. You hear like guys I like Miles Beckler is a guy I really like. You're always hearing about this 90-day online challenge. So I wanted to make sure I pushed myself at the beginning, but then I kind of had to scale back from the whiteboard videos. And those are the ones that get not all, but most of the views and the subscribers. So, as the channel's grown, you get more views, but you're doing fewer videos that really drive traffic just to make it sustainable. And so it kind of just levels out. But, but as the thing grows, you get more opportunities to collaborate with awesome people like yourself that have a community, and that really drives the subscribers too. So once you build momentum, it's like a giant ship, or it's like a train. Once you build this momentum, it's hard to get it going at the beginning, but once it's gone 70, 80 miles per hour down the railroad tracks, it's tough to stop. It just builds on itself.
Yeah, you're a good example. I mean, Neil and I, we recently did a marketing school episode on the one-man media company, and that's literally you. And guys, anything is possible. You went from 200 to 160,000. I'm looking at Social Blade right now. So March, you had 1.4 million video views. COVID hits, you jump up to 2 million again. It kind of goes down a little bit, but June, funny thing is, in June, you gained 10,000 subscribers. July, you gained 35,000. Something must have happened there.
That was my interview with Robert.
Oh, there you go. See, but you got people like Robert noticing, mentioning your name all the time. And then you do that. And it's just like, it's amazing. But anyway, I do want to come back to maybe practical things I think people can do. I think, guys, this is just a FYI. This is not financial advice. We're just giving our thoughts on this. But George, why should people start to understand macroeconomics now? Because my thing is, yes, I studied some economics in college, but I was like, man, it's too complicated for me. I'm just going to learn business. I'm going to learn investing. And I don't think I need to understand what's going on with economics. So why do you think people need to start understanding it now? And be keen to get your thoughts.
I think a great example is 2008, 2009. You could have been the best investor back then, but if you didn't understand things from a tops down approach, if you didn't understand the macro picture, it doesn't matter what you were invested in. You could have been the greatest real estate investor, the greatest stock picker, and you lost 50%. Boom, done. And so everything goes back to macro. It's these massive cross currents that we have to understand in order to position ourselves and take an educational approach and an informed approach. And there are no certainties in investing or macro or anything in life, but there are definitely probabilities. And I think that if you ignore the things we're talking about, then you're not accurately quantifying those probabilities. And you could be, you are definitely taking more risk than you realize. Whether you're investing in real estate, whether you're investing in the stock market, bonds, even precious metals, trust me, if you don't understand this stuff, you really don't understand the amount of risk and the asymmetry. As investors, we want asymmetry to the upside. And I would argue that most people right now that are whistling by the graveyard, as we said at the beginning, are taking asymmetrical bets, but the asymmetry is on the downside, not the upside.
Right.
And I think you can either get prepared or you're going to get crushed. And the real estate market in your area, not to pick on you there, but it's a great example of that. You look and you say, okay, well, were we in a housing bubble in 2006? I don't think that anyone would argue that we were not. Okay, well, prices even adjusted for inflation in Los Angeles are higher now than they were in 2006. So you can say, yeah, but real estate always goes up over time. So if I just buy it and hold it or whatever. But you're buying at the very top of a cycle. And let's just say that real estate continues to go up for the next 2 years or something like that. And you would have missed out on let's say 15% of upside. But what's your downside? Like, I would challenge anyone listening right now or watching this to go back and look at a historical chart of housing in the United States adjusted for inflation and adjusted for size. What you'll see going back to the year 1900 all the way to 2000, housing prices basically flat. And then 2000, of course, we know it just goes parabolic to 2006. Then 2012, it comes down. Where do you think it bottomed out? It bottomed out on its historic trend line, going back to 1900. There's no secret. And then 2012, it rockets back up to where we are today. So you could safely say that those prices we saw in 2012, that's pretty much your downside. So if your upside, if everything just goes perfectly, is let's call it 15%, and your downside is another 50 or 60, that's a bad bet. And you know, people say, well, if I would have taken your advice, George, over the last year, well, then I wouldn't have made this extra 5% or whatever I'm up in my housing. But that's a lot like going to a blackjack table. And you know, Eric, you and I are at a blackjack table. Let's say we're in Vegas, we're having a couple drinks. You've never played. I played a lot, you know, in my earlier days. And you've got a 19. And you say, well, should I hit or should I stay? I said, no, you got a 19, man. You want to stay on that. And you're like, oh no, George, you're too prudent. You're too, you know, you Austrians, you guys are too scared. I'm going to go ahead. I've had a few drinks. I'm feeling lucky. I'm going to hit. You go ahead and hit, you get a 2. You got blackjack. Then you look at me laughing and say, see, George, I told you, if I would have taken your stupid advice, I wouldn't have realized these gains. Well, did you do the right thing or the wrong thing? I would argue you did the wrong thing because the probabilities are against you long term. And if you continue to make that bet, you're going to go bust. Now, maybe some people would argue that you did the correct thing, but those people probably wouldn't enjoy my YouTube channel.
How much time do you have left, by the way? I just want to be cognizant of that.
Oh, it's totally up to you.
Okay, cool. So, you know, right now, I mean, pre-COVID, so in February, I basically started preparing, you know, the team. And I was like, hey, this is all coming. So I was like, you know, there's stipends for everyone, blah, blah, blah. And people thought I was overreacting. So I think, you know, look, if you overreact, your downside is capped. But if you don't overreact and things get really bad, what happens, right? So I guess the question now is, what do you think people should be doing? Like, what do you do personally, I guess? Like, what's like your portfolio makeup? Like, how does that all look? You're over there in Medellin right now. Now you're in St. Bart's. Like, you're safe like physically, but also you're protecting your assets to it. So I'm just wondering, like, what's your practical advice for what people should be doing right now?
Sure. What I do with my own portfolio is I compartmentalize it into 3 buckets. Number one, we've got insurance. I like to allocate 10%. For me, that's just physical gold. So that's just insurance against a currency devaluation. It's just, you're not, I don't think you buy or you should buy gold to get rich. You just buy gold to stay rich. And then you've got another 10% of your portfolio that I allocate exclusively to speculation. So the way I would define that is I'm just buying something because I think it's cheap and I think that it's going to go up in value over the long term. I'm a very long-term investor. In fact, pretty much everything I've purchased, except for a few homes since 2012, I've kept. I rarely sell a stock. I usually just keep it until it gets expensive and then I sell it. Then 80% of my portfolio, I allocate to investments. So I would define that as something that pays me to own it. So whether that's a cash flowing real estate, a property, whether that's a dividend paying stock, maybe it's a bond, it's got to pay me to own it. And then I like to make sure that I'm on that side of it, I'm buying things that are cheap as well. So as an example, going back to 2012, when I retired, I went almost all in with real estate in the Midwest. Why? Because it was cheap. It was super cheap. The cash flow was cheap. The debt was cheap, everything. And it turned out to be a good play there. But as long as you're buying things when they're cheap and selling them more expensive, that's really the key. What most people do is, we always hear Warren Buffett say that he wants to buy $1 for 50 cents. And that's exactly what I try to do. But most people, they don't do that. especially, in California, when you're looking at these high flying tech names, that might be fantastic companies. I'm just saying that the price of the stock might not be exactly cheap relative to their current cash flows. What most people do is they buy a dollar for $3, hoping that they can sell it for $5. And I don't like to play that game. So right now, what's cheap? I think that commodities are cheap. I listened to an interview with Jim Grant the other day, where he did a study, or someone, I believe maybe that works for him, did a study going back to 1900. And commodities relative to financial assets are at a 120-year low. So that's something that I think is pretty darn cheap. So if you can get some of those types of assets that pay you to own them, that's kind of where I'd start looking. And another way I've diversified my own portfolio is I always say I diversify my political risk, and I like to diversify my currency risk. So we talked about right now a lot of the markets in the United States being very frothy when you look at the real estate. And I'm a real estate guy. I think that's where I really have an edge. So the majority of that 80% I was referring to, for me, I like to have that in rental properties. But I've purchased several properties in Medellin, as an example, where you're still getting a 1% RV ratio. What that translates to is maybe like a 10 or 12% return cash on cash without using any leverage. But the thing that's different there is you're going into a non-correlated market. So if you have dollar denominated assets, just because those assets go down doesn't necessarily mean that the real estate in Medellin will go down. And you're going into a market that has almost zero leverage, almost no mortgages. And I won't go into the stats, but very few people, like maybe 7% of Colombians actually have a mortgage. So all these properties are owned outright. So even if they do have a downturn in the economy, no one is forced to sell. So that's a much more stable type of market. Now, I'm not saying the only place you can find that is in Medellin. There's several places around the world. If you just kind of open your mind to opportunities that initially might feel a little weird, but if you really go down there and you get into it, you realize that as far as from a risk standpoint, the risk is a lot lower than a lot of things that people would feel comfortable buying right now in the United States.
Got it. Random question, because I just, throughout this, I learned of, Peter Schiff as well, right? He's the gold guy, right? So how do you go about buying gold? This is just like, because when I go online, I'm just like, okay, there's like, it's confusing. So
yeah. Well, I'm actually talking to a bunch of gold folks that want to sponsor the channel, and to some really, really great people. But you just call up a broker and you say, hey, I'm in the United States. You buy it, they ship it to you. Generally, there's a bit of a spread there if you want to buy the physical. Right now, it's been very hard for me to buy physical. And usually what I do, regardless of price, is just whenever I make an extra, call it 100 grand or whatever, I just take 10 grand and buy gold with it. And I can't really do that right now. So what I'm doing instead of just getting the physical is I'm buying a gold fund that owns the underlying asset called, I think the ticker is PHYS. It's Rick Rule's product. He's with Sprott, and I've interviewed Rick. He's a great guy, definitely someone that's trustworthy. The custodian for that is the Canadian Mint, which I trust a lot more than the custodian of the GLD, which is the gold fund most people go into. Their custodian is HSBC. I think they've just got a lot. I'd rather be in bed with the Canadian Mint than HSBC. That's for sure. So that's kind of what I'm using right now. And maybe for your viewers, if they're to give them time to do the due diligence on maybe a company to buy the physical from, that would be a good option for them.
Got it. Again, guys, this is for entertainment, not investing advice. So where does crypto fall? I'm assuming crypto falls into risky for you. Do you have any crypto at all?
Yeah, a little bit. So just Bitcoin, but you're right. For me, that would fall into the speculative side of the portfolio, because I can't really value it. I don't really know if it's cheap. I just do know there is some significant asymmetry there to
schmuck insurance.
Yeah. So a lot of people look at it as a competitor to gold. And the gold guys always argue with the Bitcoin guys and go back and forth. I really don't understand that at all, because we're all on the same team. We all want hard money. We all don't like deficits. We all, just value savings and kind of a more traditional approach at looking at economics. And I just see them as two completely separate asset classes. They have different objectives. It's not even, to me, it's not even apples and oranges. It's oranges and Ford pickup trucks. One's insurance, one's speculative. They don't compete at all. I think we're all on the same team.
I think I agree with you there. I think it would be really helpful if you made a video on that too. Question. Obviously, okay, people need to check out your channel if they want to learn more about macro, but what else should they be studying if they're just starting out with macroeconomics?
If they're just starting, I would look at the Free to Choose series on YouTube from Milton Friedman. He did that back in the 1970s. It's fantastic. He articulates things so well. And from there, I would look at any YouTube interviews with Thomas Sowell, who is my personal favorite. And that's going to get you started. And then from there, I would just listen to podcasts like Shifts, Macro Voices, Real Vision, I think would be, those Macro Voices and Real Vision are going to be a little tougher to follow for the average person until they get up to speed. But if just to, I guess I'll plug my own thing here. If the viewer could combine watching some of my videos, especially the whiteboard videos, along with Real Vision, it's a good kind of liaison, because I go over the terminology. I explain kind of the back end and the plumbing to what they're talking about, so you can get up to speed. So when you do listen to the pros that know a heck of a lot more than I do, it'll make a lot more sense, and that industry jargon won't seem like Greek. So that's where I'd start right there. But there's just so much content out there that's just amazing when you start diving down the rabbit hole on YouTube, podcasts, and then audiobooks. But not even just the audiobooks. It's so much out there for free to really get started and get up to speed. That's how I taught myself. I've never taken a finance class. I've never taken an econ class. I almost flunked out of high school. So if I can do it and do these whiteboard videos, anyone listening to this can do the same thing.
You know what's crazy? Nobody, like, one reason I was so bored in college studying economics was just it was just too dense, right? So some of the things you're mentioning, I'm like, okay, the podcast, these Real Vision, all that sounds like it might be like the college level or maybe even 12th grade, right? So I haven't seen anything as simplified as, I mean, you've simplified it the most from what I've seen so far. But even then, I would still say let's just compare it based on grade level. Maybe it's like a 5th grade or 6th grade level. But how do people get access to like the 2nd grade level, like even below that?
I think Free to Choose.
Okay.
Yeah, I think Free to Choose, that whole series, it's really neat too, because what Milton Friedman did is I believe it was like 45 minutes where he would kind of walk you through on site. Like, I know he goes to Hong Kong and a lot of places on location to film these videos to teach you what he's talking about and give you real life examples that everyone can understand. And then the last 15 minutes, they sit down in a library and he actually debates with people who watched the video and actually disagree with him. And I think that is what we could all learn from today, where you get people in the same room that are very civilized and that are actually talking to each other and trying to think through complex problems that actually disagree. Imagine that.
Crazy, right? Working towards wrapping up here, a couple more questions. So earlier when I asked you what one of your passion points were or are right now, you mentioned freedom. So, right now, sometimes I'll eat lunch alternating between watching you. And there's another guy I watch, Nomad Capitalist, and he talks about,
I just interviewed him.
He's great. I mean, there's like going offshore, he renounced his citizenship. There's all this stuff. And he's like, yeah, you got to get out of here, blah, blah, blah. And like, secretly I'm like plotting, right? So what does freedom mean to you? And then how has that led up to, your decision with Columbia?
Well, I mean, more so my decision to come to St. Bart's. But with freedom, once you start understanding how things look at the economic level, at the macro level, you start seeing, okay, well, it would be a good idea for me to diversify my political risk. And I'm not saying that anything's going to happen in the States or that we should all be worried about anything. But I mean, look at what's happening right now. It's a great example. If people and they might not know this, but it's very difficult for Americans to travel right now. If you've got an American passport, you're pretty much persona non grata in a lot of, the European Union, and even to get to places here in the Caribbean, even Puerto Rico, that's kind of part of the United States, you've got to have a negative COVID test that has been taken within 3 days. But the problem is, especially in Florida right now, at least when I was there coming to St. Bart's, you could get the test done, but you couldn't get the results back within 5 days. So effectively, you can't leave. You got a Berlin Wall around the whole entire United States. So I think this should really be a wake-up call to Americans that we don't know what's going to happen in the future, and things can happen quickly. And if you're someone who values your personal freedom, like I do, to where I want to have the ability to go wherever I want, when I want, I don't want people telling me what to do. If I want to go and visit the UK or France, I want to be able to do that. And if I want to go back to the US, I want to be able to, so if you're someone that values that, I think now, going back to Andrew, is a great time to have a plan B. And there is no downside to this whatsoever. So what's a plan B? Well, first and foremost, get your darn passport, because I know so many Americans don't even have their passport. But then once you do that, just, listen to this content that you're referring to and consider the next time you go on vacation to maybe go to a place where you might like to set up a bank account. So let's use Colombia as an example. 3.5-hour flight from Miami. I don't know if you've been there, or you have been there, yeah. Eric, you said. So you know how gorgeous Medellin is. I mean, the perfect climate, low cost of living, fantastic people, amazing food, everything that you could want. And just go down, check it out. If you like it, maybe you just set up a bank account. Doesn't take that long. Put in $5,000 and then maybe do some more homework. And then in the future, maybe once you feel more comfortable, maybe you buy a little apartment there. You buy a rental property. So you've got some cash flow coming into that bank account that's denominated in another currency. You're starting to diversify. Then you get your investment visa, which I've done. And that kind of takes you down that path to having Colombian citizenship. Now, you can have dual citizenship. I'm not saying that you have to forego your American passport and take all these extreme measures, but you can get a Colombian passport or another one. Just sock it away in your drawer, for heaven's sakes. I don't care whether you live in Indiana or Oregon, California, wherever you are. Just put it in your safe. So if you need it sometime, then you got it, and you've got kind of an escape hatch. For people, Americans that want a plan of action that's a little bit more immediate, I'm saying that just buy an RV. I mean, it sounds crazy, but I got a lot of buddies right now in Phoenix, because that's where I went to college. And almost all of them have purchased some sort of RV or trailer thing that they can hook up to the back of their pickup truck. So if we get another round of lockdown or another round of riots or looting or whatever, they can say, you know what? I'm out. I'm going to head up to the mountains. I'm going to chill out at a campsite. I got Wi-Fi. I got my food. I'm going to relax up here for 2 or 3 weeks and just watch it from a distance. So those are kind of some things that I think people can start to do that and make, it's a fun deal. I've had a lot of enjoyment out of traveling to over 40 countries and checking this stuff out. And going back to your original question, I guess, when I was in Medellin, we were in lockdown there, just like the United States. And I don't like that. That's life is short. That's not the way I like to live. That's why I retired in the first place, because I built this monster that I'd become a slave to. And I was making all this money, but it dawned on me that I had less freedom then than I had back in college when I didn't have 2 nickels to rub together. So I was in Colombia. I didn't like the lockdown there, like the States. So I was able to get a flight to Fort Lauderdale, then go through this crazy, like Jason Bourne type impossible mission just to get down to St. Bart's. And I came to St. Bart's because a good friend of mine, a former hedge fund manager, Hugh Hendry, lives here. And I texted him from Medellin. I said, dude, is everything open up there? He's like, yeah, the restaurants are open, the beaches, the water sports, jet skis, the gym, you can actually go work out. And I said, I'm there. I'll see you in a couple weeks. I'll see you as soon as I can get there. Yeah. And then I had to go to Fort Lauderdale. I couldn't get the COVID test. So I had to fly to the Virgin Islands just to get the COVID test. just to get the test. See, that's what I'm talking about, guys. It's really getting crazy. I got the test in St. Thomas, and then from St. Thomas went to San Juan and took a semi-charter flight because it was the only flight I could get from San Juan to St. Bart's. And I've been here, and I'll stay here until something else opens up that's gives me the same level of freedom. And if I have to hang out on a gorgeous Caribbean island, it's French with the best food I've ever tasted, the clearest, most awesome water. Only got 9,000 people here. Everything's opened up. I'm perfectly okay doing that for the next couple months or so and just playing it by ear.
You got good Wi-Fi there too, man. All right. So final questions, I guess. One thing that just this quote that keeps coming back to me, Charlie Munger, show me the incentive and I'll show you the outcome. I think understanding macroeconomics shows you a lot of the incentives of the different people right there. Who owns the Fed? What are they doing right now? Why are they doing things? Do you think that's a fair thing to say? Like understanding macroeconomics shows you the incentives of other people?
100%. But understanding economics in general, I would suggest Thomas Sowell, Basic Economics, that audio book for anyone, or if you actually want to get the physical copy. That's one of the books that I actually listened to. It's fantastic. One of the things he said, he defines economics by the study of limited resources with alternative uses. So whether that's not just energy, whether that's your time, maybe it's money, everything is a cost benefit analysis. And you really have to understand that. You have to understand moral hazard, right? That goes back to what you're talking about. Look at 2008, 2009. We like to think that we live in a capitalist free market society. Not even close. In a real free market, corporations and individuals are allowed to fail. I don't care how big they are. So what we did is we took the non-free market, non-capitalist approach and bailed everyone out in 2008. Now look what we've got. Look at the incentive structure that you just created for all of these big banks and these big corporations. What are they going to do? Are they going to invest in R&D? Are they going to invest in CapEx? Are they going to hire employees? No, they're just going to buy their own shares back. They're going to lever up and buy their own shares back. Why? Look at the risk reward. They know the Fed has their back. They're not going to let the stock market go down. So you have almost zero downside, limitless upside, and you don't have to do any work. You don't have to have any more employees. You don't have to grow your business. It's just the share price goes through the roof. That's the best example I can use of the incentive structure you're talking about and how perverse it's gotten, especially since 2008.
Personal opinion, where do you think this is going in the next year, 2 years or so? Better, worse?
Stagflation. I think stagflation. A buddy of mine, Jason Burrick, who is with Wall Street for Main Street, I think he just nails it. He says the objective and their angle is going to be stagflate, lie, and tax. And so stagflation, why? Because we see high unemployment. We're most likely going to get consumer prices going up. So that's going to be your stagflation. The government, in a perverse way, kind of likes that because if they can get enough inflation, that allows them to pay back that 26 trillion that they have in debt with cheaper devalued dollars. So it's actually, it benefits debtors, and the United States is the biggest debtor nation of all time. And then I think they're going to lie about it. Through things like the CPI, that's if you look at the way they measure the CPI, it is totally bogus. Same thing with the unemployment number. So they're going to say that the CPI, which is the rate of inflation measured by the government, is, let's say, at 2 or 3%, when really it's probably running in what they'll try to make it run in the future. Now, whether they can do it or not is a different story, but they'll try to run it, let's say, 10%. And then they're going to increase taxes. They're going to try to, I think they're going to come out with a wealth tax. I think they take capital gains long-term up to income. I think in a lot of the markets like where they've got these pension fund issues, such as California, such as Illinois, such as New Jersey, I think that they're going to raise property taxes. And I think that's how they're going to approach this problem of just these massive debts that just really can't be serviced. Most people don't realize that they know the government has the highest debt of all time, but they don't realize that we're at consumer debt is at all-time highs, corporate debt is at all-time highs, and state debt is at all-time highs prior to COVID. And since COVID, The personal debt might have come down a little bit, but everything else has just gone parabolic.
And the scariest thing about this is we're just talking about, what's going on with the government. Like, how are people going to react to this? Then again, we're talking about incentives. So that we'll leave that to people's own imagination. But I'm going to hear the final wrap-up questions. Final. This is amazing. I could just keep going. Like I said, I have a list of other questions over here, but we're not going to get to it today, another time. George, what is one new tool that you've added in the last 12 months that has added a lot of value to your life? So it could be like a Peloton bike, it could be an app, whatever.
One tool. Well, I would say, it's probably an obvious answer, but just Zoom and Skype. Just because I'm able to do all these interviews. Prior to COVID, I had most of my employees coming into an office daily to do all the editing and to do these whiteboard videos. And then when COVID hit, even prior, I was a little ahead of the game like you. I said, listen, guys, I want you to stay home. I don't want to jeopardize your health. I'll pay you. Let's just try to figure out a way to do this while you guys are at home. So we figured out a way to continue to do whiteboard videos through like WeTransfer. So now when you guys see a whiteboard video, it takes me probably 12 hours to do it, even if it kind of looks rinky-dink here in my living room. But it only takes maybe 3 or 4 hours to shoot the video, but then I've got to upload everything to them. If I can't get a good internet connection, then I have to proof every round of edits. Then we do the 3 steps, and then it's quite a process. But my point is we were able to figure out how to do that process remotely, which is really, really cool, because now it gives me even more freedom and flexibility to where I can be in St. Bart's and I can continue to produce this type of content. So just those little things that I'm sure everyone is using is what I've leveraged significantly over the last few months.
Got it. How about must-read book for the audience?
Beat the Dealer by Ed Thorpe. So the reason I suggest that for everyone, regardless of what you're doing, whether you're interested in macro business or economics, is when you learn how to play blackjack professionally, not that you'll want to do that, but it'll train your mind to think in terms of probabilities. And I can't think of any other skill that will benefit you more, not only in investing, but in business. I can completely say that I wouldn't say 100% of my success in business, but I would attribute a large percentage of my success in business to first and foremost learning blackjack. Because I would go into industries that they really hadn't been able to quantify anything, just basic stuff, like closing ratios, to just figure out it's really a numbers game. And you could take the principles of blackjack and apply it, and you could just increase revenues significantly if you were able to keep the other metrics. And I know it's kind of doesn't make a lot of sense because that's another hour-long conversation. But definitely check that out. And then as far as investing directly, I would strongly suggest the Market Wizards books. These were done by Jack Schwager in the late 80s and the 90s. I think you might have a more recent one. And then as far as just straight economics, I'd start with Thomas Sowell, Basic Economics.
Your gambling example resonates with me because I used to play a ton of poker. So it's the same thing. You have to think long-term. You're playing the person, you're playing the numbers. And it's going to work out. Again, it's a long-term investor mindset. You take your shots, right? When you have your 11 or you have a 10, I'm going to take my shot. If I have a straight flush draw, I'm going all in. I don't care. I feel like I have the nuts, right? So it's the same thing. I think people definitely should look at, whether it's poker or blackjack, and look at that as your first kind of training into investing, right?
Well, you'll notice if you read these Market Wizards books, which I think everyone should, it's these interviews with all these incredible investors like Ed Thorpe, like Stan Druckenmiller, Jim Rogers. And you'll notice a lot of these guys actually started by playing blackjack. Wow. Ed Thorpe is a great example of that. I don't know if everyone knows who Ed Thorpe is, but he's the MIT professor that
21.
Yeah. Okay. I believe that was him, but he was the first guy to create basic strategy. and do this through a computer. And most people don't realize, but he figured out how to beat blackjack, but he also figured out how to beat roulette, which really kind of blew my mind. He built a little computer that he kept in his shoe, and that every time the thing would spin one rotation, he'd click it in his shoe, and that would give him like a little thing in his ear, like a little beep, and then he'd know whether to go on red or black. I mean, it's just like crazy. This guy, the level of intelligence is just incredible. It's a real neat story. Yeah.
Cool. Well, George, final question here. What is the most compelling thing that you've read or watched recently?
I would say a podcast episode on Grant Williams does it with Bill Fleckenstein. He just created this new podcast called The End Game, and I highly suggest it. And they had a guy on, Mike Green, who I believe either we were talking about prior to recording or while we were recording. And Mike discusses passive investing. And Mike is like a super genius. I think he worked with Peter Thiel quite a bit. And you can tell that this guy's just razor sharp in the first 30 seconds that you listen to him. But he went in and did all of this analysis on the money, the assets going from active managers into passive. And you see it all the time. You watch anyone's YouTube channel, any of these gurus, even listen to Warren Buffett. They say, oh, just go into an index fund, go into an index fund, go into an index fund, as if there's no downside. But what Mike has done is he's looked at how this changes the structure of the entire market. And I just to give you kind of the punchline, this is not like tinfoil hat stuff. He shows you how this can happen. And what he outlines is how the market, the stock market, can literally go to zero. Zero. And I don't mean go down a lot like the GFC. I mean, quite literally go to zero. And I'll just let everyone kind of digest that and use that as a teaser so they can go to that episode and check it out. I think it was maybe 3 or 4 weeks ago. If you look up the Endgame Grant Williams and then the Mike Green episode, it'll completely blow your mind.
Amazing, George. I mean, we literally went, I hardly go over 30 minutes on these. We went for over an hour. What is the best way for people to find you online?
Oh, just go to my YouTube channel. It's at George Gammon. My last name is spelled Gammon. Same thing at Twitter. Just Google me and I'll pop right up.
All right, George, thanks so much for doing this.